In this week's update, US earnings season stronger start than forecast. Critical Fed meeting next week. And market character has not changed, so just keep going. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Let's start with the usual investing perspective, the big picture. US indices continued up at record levels, confounding a lot of the critics and the bearish part of the community. Retail sales surprised to the upside, so that was a good piece of news in what was a week that had lots of good news. There were other favourable economic data. The jobs numbers point to the US labour market being pretty resilient, so things still looking okay there. Bank earnings season started, and the net interest margins continue to rise as they have been quarter by quarter since 2024, indicating that funding costs are easing. And with net interest margins rising for the US banks, that's a very solid footing for the US economy and for the US stock market. So it's unlikely that bad things are about to happen unless someone makes a policy mistake, and you know who that might be. But nevertheless, that's unpredictable. And it was quite a solid start to earnings season, as we'll see in a couple of slides. So despite the anxiety that a lot of people feel when markets hit new all-time highs, the question I would ask is, well, why not? Because there are an awful lot of factors that would support what the US market is doing. So that'll be the tone of today's video. There's actually not a problem with the US market doing what it's doing. Now, over the last couple of weeks, I have pursued the theme of getting ready, being a little more cautious, but that is not taking action to get out of the market or change your position. It just means that, as I said last week, I think, or the week before, I think it's a good move to have a state of heightened awareness of what's going on. Just be prepared to move quickly if the data supports it, if the charts support it. Don't get caught up in the emotion that often happens towards the end of really bullish phases, where people just assume that the market is going to continue. Now, I think the balance of probability is that the US market will continue to the upside. That's the balance of probability. But that doesn't mean that you get complacent about it. Now, if we look at the American CPI, the inflationary tariff impacts, they're only quite minor at this stage. Now, the big question is there a lot worse to come in the next couple of months? Or is the impact of the tariff on inflation, is that being overstated? And of course, we don't know the answer to that at this stage. But at this point in time, a lot of people were worried that June would reflect the impact of tariffs, and it really hasn't much at this stage. The results were pretty much in line with expectations. Now, I've been reading, particularly of late, and this always happens when markets are continually week after week hitting new all-time highs, and that is the anxiety comes out about, well, where's the top? The market's going to crash because of X, Y, Z. So there are many reasons to feel anxious, and here's just a few of them. This is just a small list. There are geopolitical risks left, right, and centre. We've got soaring debt in the US and in many other places that people have been predicting for 2 decades is going to bring the whole financial system down. Valuations are, of course, always being brought into question when markets are setting new all-time highs. The tariff impacts, naturally. Trump's unpredictability. There are just so many, so et cetera, et cetera. There are lots of things that could go wrong. There are lots of things that could cause you to logically conclude that the market is close to a top. But I'll remind you of a very famous statement that goes something like this. This isn't exactly it, but it's pretty close. More money has been lost by investors anticipating the next crash than if they'd just stayed invested. So keep that thought in mind, and that's why I'm not suggesting that any action at the moment should be taken. Just a heightened state of awareness of where we're at, I think, is prudent. And of course, important to get the broader advice that you need, be it investment, legal, or any other advice before you act on anything which is contained in these videos. Let's look at the US market now. The S&P ended up rising just over 0.5% for the week, and the Nasdaq by 1.5%, so a much better week for the growth-orientated stocks. Now, amongst the S&P 500, 12% have reported, and a high 83% have beaten earnings forecasts at this stage. Now, it's only a small sample. It's only a bit over 10% of the market, but 83% is a good beat rate, and the average beat is just a tick under 8%. So that's all pretty solid, and that is a good underpinning for the US market, which of course then in turn influences the sentiment for all other stock markets around the world. That's why it's so important to be aware of what's happening with the US market. Q2, the earnings were up 5.6% year on year. That's a blended average. That's not too bad. Certainly is not a catalyst for the market to start to sell off. And the major banks that have reported so far all beat expectations. So there's not really very much that you can point at tangibly that's actually going wrong. There's a lot of things that could go wrong, but they're not actually manifesting themselves at this point in time. The US dollar gained a little bit as the hopes of another Fed rate cut dimmed just a little bit. The 10-year yield slipped back slightly to 4.42, and the VIX was steady at 16.4. Let's go and look at some charts. We'll start with the Nasdaq, and you can see since we had a little pause, a little sideways in the middle of June, but since then it's been pretty much straight up, and it's tracking above the 8-day moving average, which is a sign of real strength. Tracking above the 20-day moving average is a strong market. But when it's tracking above something as short-term as the 8-day, then you know you've got a very strong market. The candles are a little bit on an intraday basis. They're not quite as positive as they were down here where we had longer ranges closing on their highs. So one could argue that the momentum is maybe leading towards some sort of pause or weakening. But at the moment, we're not seeing it. And as long as we remain above, particularly the 20-day moving average, then the US market is on pretty solid ground. If we look at the S&P, very similar, so new all-time highs there, and that's a weekly chart on the S&P, and you can see just how sharp a rebound we've had since early April, which was the end of the fallout from the surprise tariff announcements. If we look at some of the key spreads, this is the Nasdaq versus the S&P, and the Nasdaq continues to gain ground. The short-term moving averages indicating that we've got very good momentum with that market at the moment. This is consumer discretionary versus consumer staples, also making more headway, indicating a pretty bullish sentiment in America. And this is S&P versus gold, not a lot of change there. Importantly, semiconductors, which I look at all the time. This is a weekly chart, another new all-time high in semiconductors as well. Yes, NVIDIA is doing really well, and there was some positive news around NVIDIA, but it's not the only one. There are several other major semiconductor companies in America that also have charts that are looking very, very solid. If we look at it on a sector basis, technology continues to lead. Consumer discretionary has now started to turn up again quite strongly. And of course, the banks have done quite well as well with the start of earnings season. In Australia, information technology continues to lead the way. Energy is still up there as we're getting a rebound in that sector. Whether it's sustainable or not is another question. Personally, I don't trust it. And then we've got small caps, certainly gaining some ground, and then healthcare and finance under that. And then we come down to materials at the bottom of the tree. So that's where we sit with the global charts. Aussie stocks, the Aussie dollar slipped a bit, of course, with that added strength in the US dollar, back down to the mid-64s. The bond market in Australia is betting on a rate cut coming up soon. And that should logically, not that logic always plays out, but that should logically add to any downward pressure on the Aussie dollar. And if the Fed does hold off on more interest rate cuts, which is starting to look more likely, then that will put upward pressure on the US dollar as well. So the Aussie dollar appears to be forming into a bit of a tight range between 64 and 66. It seems to be where we're sitting. The question, of course, for Australia is, will there be another 25 basis point cut on August 12 when the RBA meets? And that is probably looking much more likely as well. The ASX index rose 2.05% for the week, so it was a strong week and should be a good start again on Monday morning. Set new all-time highs. But of course, as I remind viewers every week, the ASX 200 is hardly a good barometer of the Australian market because it just represents such a small part of the market. It's really absolutely dominated by the top 10 stocks. So it's a bit like the Dow Jones in America, really. It says something about sentiment, but it doesn't really represent the broader market, which is what most investors are working with. So very solid, broad-based mix of growth and defensives and cyclicals are doing okay in the Australian market. So that's the far more relevant fact, not what the ASX 200 is doing. The Australian market has got a lot of very broadly based advances. And there are many really outstanding trends, really wealth-building trends in the Australian market. So let's just go and have a look at that index, just for the record. So a very strong session on Friday to finish the week, and you can see it's quite an emphatic breakout, which had been building up for a little while. We've just been plateauing along here since early June, and then finally on the breakout, certainly with some momentum. While I'm here, let's look at precious metals. This is silver on a daily chart, finished above $38 for the week, so that is trending quite nicely, setting higher highs and higher lows. So that's a very positive looking chart. Gold on a daily chart in US dollars, still consolidating sideways as it has been since the middle of April, but you would have to think that the next move is likely to be to the upside. Translate that to Australian dollars, and we're doing something similar because of the currency impact. And finally, Bitcoin continues to show real strength. This is a daily chart, and we finished at 118,000 for the week. And as I've been noting for members, the institutional acceptance of cryptocurrencies in all its forms, not just Bitcoin, but all its forms and all of the service providers, is just becoming quite stark, is probably the best term to use. I think any suggestion that we're not going to end up with cryptocurrency as part of the mainstream asset mix, I think is becoming quickly more unlikely. All right, so just summarising precious metals. So gold was down just a touch to $33.50. There's the silver price just over $38. And gold stocks, I didn't have any comment to make on gold stocks. Nothing has changed since last week. Turning to other commodities, copper, $5.55. So it's maintained its recent strength. But there is certainly some uncertainty around the copper price because of just the tariff dynamics that have caused a significant distortion in the copper market. So I wouldn't bet either way on copper. It could move to the upside because the long-term demand drivers are certainly there. But in the short term, we could see a bit of backtracking from copper by the end of the year, particularly if there's any adjustment to those copper tariff rates. From Australia's point of view, we remain a key low-risk supplier in a world which has become very uncertain now because of tariffs. And contrary to popular belief, we don't actually export very much copper at all to the US, less than 1% of our total copper exports. So that provides an opportunity for us to gain traction with other countries around the world Crude oil, 67.3. OPEC is set to boost production, which should keep a bit of a bearish outlook on the oil price. And there's the copper chart. So since those tariffs were announced, which caused a big jump, 10% jump from $5 to $5.50, we've just been holding in that range. So wrapping it up, there is absolutely no reason for the US market to fall. So don't buy into the narrative that because we're at all-time highs and because the Schiller ratio or some such is showing this, don't buy into that narrative. The US market might fall, but then again, it might not. So it's absolutely pointless trying to take action based on that. Just stick to your plan and keep going until something changes. And at the moment, there is far more reason for the US market to keep going up. And that's what it's doing. So while it's doing that, just stay the journey. If you step back and think about it, why get out early unless you don't trust your exit process or your hedging process? Or even worse, you don't have one. If you don't have one, then you're understandably justified being nervous about what the market might do. But if you've got a good, robust game plan and you understand what the market signals look like, where you should make adjustments to your portfolio, then just relax and just stay with what is until it is something else. So you just own high quality, high probability stocks, and those two things go together. You want to just focus on high quality stocks. They've also got to have a high probability of continuing to grow their business and their earnings strongly, and just have a simple game plan that keeps you on track. And that's it. Good, successful investing is not a whole lot more complicated than that. Portfolio analysts this week, there'll be some more gems coming up through Q&A, I'm sure, and there was certainly a good one uncovered last week. So for anyone that's not tried the portfolio analyst service, there is a 2-week trial for $1 available. All right, that's it for this week. There's more information on the website. There is my email address, and I'll be back with you next Sunday. Cheers.